Hello, good evening, everyone, and welcome to our session today. My name is Sandrine Hibarigobeka, and I'm the co-president of the McGill Black Alumni Association. On behalf of the MBAA, welcome to Preparing for Your Future, Tax and Financial Planning Tips in collaboration with RBC Wealth Management. We are very pleased to have two speakers join us today. We have Jerry Mesidor and Prishant Patel from RBC Wealth Management, and with them, we will dive into the basics of Canadian tax structure, learn helpful tips on financial planning, and explore key tax strategies that you can put to work. Throughout the presentation and at the end, we'll have time for audience Q&A. So please feel free to use the chat and if you have any questions at all during the presentation. So now it's my pleasure to briefly introduce our guests today. We have Jerry, who is a private banker with RBC Wealth Management. He is a seasoned professional in corporate finance, strategic planning, and personal wealth planning. He brings over 20 years of corporate and financial services experience to his role, serving high net worth clients in Montreal and surrounding areas. He draws on extensive experience to advise a number of issues that affect business owner and professional clients, including banking, lending, and wealth management. Jerry holds a Bachelor of Business Administration and Accounting, as well as a CPA, CMA, and financial planning designation. Welcome, Jerry.
Welcome. Thank you, alumni.
Thank you. And as well, we have Prishant Patel joining us. He is the Vice President and High Net Worth Planning Services with RBC and has assisted with high net worth families with tax, estate, and retirement matters since 1992. His guidance supports clients in their relationships with external professional advisors, whom he frequently interacts with. His expertise includes tax and estate planning for executives, business owners, retirees, professionals, and individuals with US issues as well. He also assists individuals facing significant financial events, for example, sale of business, financial windfall, retirement, job loss, and other issues. He is a certified financial planner, associate of the Society of Actuaries, and a member of both Society of Trust and Estate Practitioners and Canadian Tax Foundation. Welcome, Prashant.
Thank you, Sandrine, and hello, everyone.
Thank you. And without further ado, I'll turn it over to you both.
Thank you, Sandrine. I just want to cover the agenda. So we will go over all the financial planning tips that we try to give to our high net worth clients. First and foremost, the RBC Wealth Management Division. I just want to cover, if you allow me, that division. The RBC Wealth Management Division, we're a division of RBC. RBC have 56 different divisions. That division includes RBC Private Banking, RBC Dominion Securities, Trust, and Insurance. Our goal is to advise high net worth individuals and their families into the management and increase of wealth. So today we're going to cover the Canadian tax fundamentals, the difference between RSPs and tax-free saving, the Canadian real estate planning. We'll also go over a sample of a financial plan, high net worth and tax strategies, financial planning checklists, and there will be a Q&A also at the end. But as Sandrine mentioned, we can go over, we'll take questions as they come. Now I'll pass it to Prashant.
Great, thank you, Jerry. So I can go through the agenda here, and just so people are aware of the different topics we're going to cover. Want to spend some time just going through, I know there's probably people here with different skill sets, but just want to maybe start with the fundamentals of Canadian tax, as there are some misconceptions and myths out there, and want to make sure that you're very clear on that. We're going to go through, RSP and TFSA. There tends to be a debate out there in terms of, should I contribute to an RSP or a TFSA or both? We're going to hopefully give you some insight there. The real estate market is booming in Canada, Montreal, Toronto, Vancouver in particular. I'll talk a little bit about that. And then I'm going to pass it back to Jerry to go through a sample financial plan. These are types of financial plans and projections that we're producing for our clients to project what their future looks like, retirement, things like that. But back to me for high net worth tax strategies. And this is where, just to give you some insight, hopefully everyone on this this webinar becomes very successful and is a very high income, and so we wanted to share with you what are some of our higher net worth clients looking at when it comes to tax minimization strategies. And then Jerry will end off with a financial planning checklist that all of you, can consider for your own personal financial situation as a wrap up. As we mentioned, we're happy to take questions through the chat function during the presentation, as well as after. So we'll get started. And what I'm going to do is, of course, RBC, we have to provide our disclaimer and making sure that, although today you're going to hear about a lot of tax strategies and financial planning information, hopefully a lot of it is worthwhile to your own family now or in the future. But it is important to retain some good tax and legal accounting and legal services. At RBC, we can provide a lot of good strategies and guidance, but ultimately for certain, tax preparation and setting up certain structures, you do have to deal with your own accountants and lawyers. Okay, so let's start off with just some basic fundamentals. Again, some of this may be a refresher for many of you, but I do find that there's some misconceptions when it comes to tax in Canada. And I joke that, there's certain things that Canadians like to complain about over and over again. And, things like the weather, of course, and politics and the government. And, tax is very high on that list. We all feel that we're paying way too much tax. And of course, in Toronto, where I sit, we like to complain about the Toronto Maple Leafs. And I'm sure you in Montreal are happy that the Habs went pretty far this year. So congratulations on that. So back to this tax information. So just so you're aware, as a Canadian resident, which I'm assuming most of you are, you're taxed on your worldwide income. So income that you earn, of course, in Canada, employment income, investment income, but any income that you may have earned outside Canada is likely subject to Canadian tax. And we tax on residency in Canada, not citizenship. So unlike the US, if you're a US citizen living in Canada, and it's my understanding there's over 1 million US citizens living in Canada, you're taxed both in Canada and the US, and that's a bit of a burden as a US citizen. So what we have here in Canada is the honor system. Yes, you may receive a T4 or a T5 slip from your employer or the bank, and that's a copy of that is sent to CRA, so they know exactly what type of income you're making. But there are certain types of things where it's more on the honor system, like if you have rental income or if you have income outside Canada, that as a Canadian resident taxpayer, you have to really report that on the honor system. So as you can see by this table, this gives you a bit of a perspective, and I'm using Quebec tax rates, as you can see, in terms of the different tax rates in Canada, depending on the different types of income. So one of the myths out there is people say, well, I'm paying 50% tax in Canada, and that's not really the case for most Canadians. If you look at someone, if you look at this table, and someone who's earning, let's say, 100,000 of income, they may think that they're paying 50% tax on that income, which is $50,000. But because we have a graduated tax system, meaning that your first certain amount of income is taxed at a very low rate, and then your next tranche is taxed at a higher rate, and so forth, the blended, or what we call the average tax rate for someone making 100,000 is 30%, and that's 30,000 of tax. So 30,000 divided by 100, that's really the tax you're paying. What you may be thinking about is your marginal tax rate, is where for each dollar of income above 100,000, that person is taxed at 45%. And you don't get to the 50% marginal tax rate until your income starts to exceed $200,000. But at the end of the day, the actual tax you're paying to CRA and Revenue Quebec, for those in Quebec, is more your average tax rate. And as you can see, based on your income, even someone earning 200,000, it's only 40%. But once you're over every dollar above that income level, that's when you start paying that 50% tax. When it comes to investment income, that's another source of income. Many of you may have your employment income and that's your major source of income. Maybe you have an RRSP or TFSA. If you have started some savings outside of the RRSP and TFSA, or if you have a rental property, that's when you're starting to generate investment income that's going to be taxable. And as you can see here on this table, the highest taxed investment income is interest income and foreign dividends. Canadian dividend income from public companies like blue chip public companies, Royal Bank, Bell Canada, those types of companies are taxed lower than interest income and foreign dividends. And capital gains is taxed at half of interest income and foreign dividends currently. So there's some speculation out there that the government is going to increase the capital gains tax rates, where only 50% is taxable now, to potentially 75%. And that's something that you maybe, if you're following the news, the NDP party is pushing towards, to have, of course, not only higher taxes for the 1% and the rich, but also a higher capital gains tax. It's unclear if it's going to happen. I know we have potentially an election coming and potentially a budget, but we're kind of wait and see approach. But this is a very important slide, because although when it comes to investing, it's important to look at your risk tolerance. Yes, capital gains is taxed the lowest, but it typically involves taking greater investment risk compared to interest income. So that's something to keep in mind. Okay. One of the things I wanted to mention before I end up this section is the fact that, believe it or not, there is ways we can earn tax-free income in Canada. And here's a laundry list of some tax-free income sources in Canada. Obviously, this is great because we're not paying any tax. So everyone in Canada, regardless of their age, and even if they're making $1 million, the first $15,000 of income is tax-free to everyone because of your basic personal credit. And if you have a spouse that's staying at home, or if you're over the age of 65, then that tax-free income amount is even higher than $15,000. I mentioned the first 50% of capital gains is tax-free. If you sell your home, your principal residence, regardless of whether it's sold for $1 million or $10 million, it's going to be tax-free. Unlike the US, where they have a cap on how much is going to be tax-free, it's only $250,000 of a gain per spouse on a principal residence is tax-free in the US. In Canada, it's unlimited. Again, this is something that's speculating. Will the government continue to allow unlimited tax-free principal residence? We'll wait and see. Lottery winnings is tax-free in Canada, not tax-free in the US. There's been massive Lotto Max and Lotto 649, $50–60 million, all tax-free on the receipt of it. But of course, if I take that $50 million that I won and invest it and start generating investment income, well, that investment income is going to be taxable per my previous slide. Tax-free savings account, I'll talk a little about that. As the name suggests, it's tax-free. Life insurance, I'll also mention that later on in the presentation. That's tax-free as well, both on the growth and upon death, it's tax-free to your beneficiaries. And last but not least is gifts received. So if your rich uncle is being kind and gives you $50,000, that's tax-free in Canada. It's not always tax-free in other parts of the world, but in Canada, any gifts you receive is tax-free. So I just wanted to highlight some tax-free income sources. So before I go to the next section, I just want to take a look at the chat and see if there's any questions. I do see questions here. And it says here, I'm a nurse working part-time in various nursing roles where I'm salaried. I'm wondering if there's a way for me to cover my work expenses from home through my taxes. Yes, with COVID, the government has come out with some new home office types of expenses deductions that salaried employees can take. And there's two methods that can happen. One is you can take a flat $2 per day you're working from home as an expense up to a maximum of $400. So you don't have to furnish any receipts. You don't have to prove anything to CRA. It's basically $2, working from home per day up to a maximum of $400. If you feel your expenses at home are more than $400, then in those cases, you would have to, actually detail those on form T776, I believe it is. So again, there's some more intricate rules related to that, and some special rules came out due to COVID, people working from home, and so you definitely want to speak to your accountant or check on the CRA website. For a new grad, do we recommend that we do a TFSA or RRSP to start off with? Well, that's a great segue to my next section, so I'm gonna hold off on answering that, and hopefully my talk can answer that question for you. So let's talk about the TFSA. This was introduced in 2009 and has really become a hit with many Canadians, but there's still a lot of people there that are not taking advantage of the TFSA. So what is a TFSA? Well, first of all, you have to be 18 or older and to contribute to a TFSA. And the contribution is $6,000 per year, every year into TFSA since 2009. In certain years prior to this year, it actually bumped up. The Conservatives, when they're in power, they bumped it up to 10,000, but the Liberals brought it back down to 6,000. So to make a long story short, if you've never contributed to a TFSA and you've been 18 since 2009, then your TFSA cumulative room, because you can carry forward unused TFSA room, is $72,500. So a pretty significant pop that you can put in to a TFSA and start generating tax-free income. However, it's different from an RRSP in that every dollar you put in is not tax deductible. This is after-tax income that you're putting into the TFSA. But really, the benefit of the TFSA is, as the name suggests, is all of the income earned in the TFSA and all of the withdrawals is going to be tax-free, unlike an RRSP, which I'll refer to shortly. So, it can be a fantastic tool. I've seen people use a TFSA for, savings towards purchase of a home or a cottage or a vacation. Or other people try to be speculative in their TFSA, saying, you know what, it's not a big amount that I can put in, but let me try to hit a home run. Let me try to find the next Google or Tesla. And if that TFSA goes from $10,000 to $1 million, that's all tax-free, believe it or not. So, there's different approaches to how you actually use a TFSA, and everyone's different, of course. And as I mentioned, you can withdraw a TFSA at any time for any purpose. At any age, it doesn't matter, and so that's a fantastic, a rule there. And finally, you have the suite of investment options. You can buy, stocks, you can buy bonds, you can buy GICs. There's lots of things very similar to an RRSP. Is the same investments you can have in a TFSA. So here's a little bit of a checklist or a table comparing a TFSA to an RRSP, as well as for those individuals that have maximized maybe their TFSA and RRSP and have surplus money, then you could have what we call a non-registered investment account, which of course the investment income in that is taxable each and every year. So really the key difference between a TFSA and RRSP is with an RRSP, every dollar you put in is tax deductible on your tax return. It grows tax without any tax, but then when you pull it out, you got to pay the piper and you got to pay tax. The TFSA is almost the reverse of that, in that every dollar you put in, non-tax deductible, it does grow tax-free, similar to the RRSP, but every dollar you pull out of the TFSA is not taxable, it's tax-free. So that's really the key difference between the two. And really people ask, well, what should I do? Should I do a TFSA and RRSP? Should I do both? Every person is different. There's not a cookie cutter answer. Some rule of thumbs tend to be, if you're, let's say you're earning $100,000 and you're starting to pay, starting to get up there in the high tax bracket, but you think that in retirement, you're going to be a lower tax bracket. In theory, most people during their work years, they're in a high bracket, and then in retirement, they're in a low bracket, unless you're just starting out and you're not earning a lot of income. But generally, if your income is high now and it's going to be low later, RSP tends to be better than TFSA because you're getting that big tax deduction. And when you pull it out, you'll be in a lower tax bracket. The reverse is if you expect your retirement income to be very high compared to what you're earning now, TFSA is probably better for you. And if you expect your retirement income to be level to what you're earning now, then there's really no difference between a TFSA and RSP, and you can actually do the math. It actually results in the same benefit. Ideally, if we are able to, from a financial standpoint, to do both, you know, that's the best. And what some people will do is they will make that RSP contribution, and whatever tax savings they generate from that RSP contribution and deduction, they will invest that tax refund in the TFSA. So you're kind of getting the best of both worlds. So that's an option. I just want to see here, because I think, yeah, there was one question. Do you need to be a Canadian resident to have a TFSA? And the answer is yes. You can only contribute to a TFSA as a Canadian resident. But if you leave Canada, you can keep your TFSA and it will continue to grow tax-free for Canadian purposes. But we have many Canadians moving to the US and they contributed to a TFSA while in Canada. When they leave Canada and go to the US, the IRS does not recognize the TFSA, so it will start to be taxable for US purposes. So for many US people, it doesn't make sense to have a TFSA. So that was that. I think there was another question about the individual for the new grad. You recommend that we have a TFSA or RSP. Well, quite frankly, if you're a new grad, you're probably not making a lot of money. And back to my original comment that if your income is very low right now, a TFSA you may be better off with a TFSA until your income starts to get higher. And of course, you'd never lose that RSP contribution room, right? It accumulates just like a TFSA. So when your income starts getting higher, you can do a pop into your RSP, maybe get a big tax deduction. So I would say for a new grad, you know, I think the TFSA, and it's a lot more flexible. Let's say, you know, let's say you need money, you want to go to MBA school, or, you know, you need money for a house. You can use that TFSA without any tax consequences. Okay, so that's that. And let's move on to the next section. And I'm going to cover this section, and I'll turn it back to Jerry to go over our financial plan. So we wanted to cover a section on real estate because it's such a hot topic these days. You know, real estate prices are just booming across Canada. Some people are dabbling into real estate investments. Your home is probably gone up significantly. And, you know, there's a lot of questions about real estate investing. So first of all, RBC has done a lot of work. We have, if you go on the RBC website, the public website, there's some great reports on real estate investing and affordability in Canada, real estate prices. I took a snapshot out of a recent RBC economics report on the real estate prices in major cities across Canada. And you can see the ones I've highlighted here, Vancouver, Toronto, and the Montreal, you know, prices are just astronomical, particularly in the Vancouver and Toronto area. And these are average prices of a single family detached home. Condos and apartments, of course, are less, but this is a single family detached home. What's interesting is on the right-hand side of this slide is the RBC housing affordability measure. And what that is basically saying the average income household in Canada, or in that particular city, how much of their pre-tax income do they need to spend on housing, mortgage, property taxes, and utilities. And it's quite amazing that the average person in Vancouver and Toronto, almost 100% of their income is used towards their housing if they're buying a average home in that city. So clearly, that may not be affordable for them. You know, looking at Montreal, you know, almost 50% of the average person's income is used towards housing. And as you can see by the you know, the increases, you know, Montreal has had a very high increase in the price of their homes in recent years. So anyways, as you can see, and probably not news to anyone on this call, that real estate continues to boom, but you know, we'll see what happens in the near future. Now, I wanted to just talk a little bit about the taxation of real estate in Canada. Some of you, may be looking at investing in real estate properties and having rental income, things like that. So the first thing, though, as I mentioned before, just for your own home, it's unlimited tax-free capital gain on your principal residence. However, you can only have one principal residence per family unit. You cannot have two per spouse. That used to be the case before 1981, way back when people had a city home and a cottage, and they sold both of them tax-free for both. Now, only one of your properties, whether it be a city home or a cottage, can be your principal residence. You must legally own the home and you must inhabit the home. What we're seeing is CRA is really aggressively auditing people that are flipping condos, flipping homes, and trying to make a quick profit, maybe buying a kind of a tear down or a depressed property and repairing it and flipping it. If you haven't lived in that home, that's not your principal residence. You're gonna have to pay tax on that. And if you're doing a lot of that flipping, then it may be considered a business where you don't get the capital gain, where only 50% is taxable. It may be 100% taxable, just like employment income. So, for those of you that are in that, have that mindset, you want to be a little careful because CRA is really cracking down on those types of activities. If you have a rental property, quite simply, your rental income minus your rental expenses, that's what's taxable to you. So, I'm getting rental income, but I have a mortgage. I can deduct the interest. I can deduct the property taxes. I can deduct any maintenance, any utilities, anything that I'm paying out of my pocket. I can depreciate the property, and then that is my net rental income for tax purposes. And as I mentioned, on sale, only 50% will be taxable of the gain, unless it's a business. Last but not least, I just wanted to share with you for some of our higher net worth clients that are starting to buy more real estate properties, they're asking, should I own the property in my personal name or should I own it in a corporation? Well, yeah, personal is the simplest. Having a corporation creates a bit more complexity, but keeping in mind that when it comes to owning real estate and rental, you have tenants, you have potential liabilities, slip and fall. You want to protect your assets from these creditors. So therefore, you want to increase your liability insurance, but also that's why, people that are starting to invest in real estate, they will now own that real estate rental property in a corporation to provide a little bit of limited liability from their personal assets. And you can get a bit more sophisticated with the structure of that corporation for tax and estate planning reasons. And also check with your banker because there could be some differences from a financing perspective if you have that property in your personal name versus in a corporation. So I just want to see if there's any questions. Let me just very quickly see if there's any questions on the real estate side of things. Actually, this is an RSP question. Maybe I'll just quickly address that. If someone contributes too much in an RSP, can there be a clawback on OAS when retired? Yeah, excellent question. So that comes to the fact that all RSP withdrawals are fully taxable. And if you're over the age of 65 and you're getting the old age security, then we have what we call a clawback for high income earners with the old age security. If your income, including your RSP withdrawals after 65, is over about $75,000, then you will have a clawback for every dollar above 75,000, 15 cents of your old age security will be clawed back. And so, that's why, you want to be careful of, some people say you have too much in your RSP because it could claw back your old age security. But to be honest, the old age security clawback, I mean, it's not significant. So I wouldn't, that shouldn't be the reason why you do not put money into the RSP, because there's such a great tax benefit for the RSP. I wouldn't be too fussed about the old age security clawback in the grand scheme of things. So there's a number of other questions, but quite a few questions. But I think in the interest of time, and maybe at the end we can come back to some of these questions, I'd like to turn it over to Jerry, who's going to go through a sample financial plan And I think you're going to find this quite interesting. These are things that we produce for our clients, and it's a great type of service, and really helps you kind of, set your stage for your future. So what I'm going to do is I'm going to minimize this presentation, and I'm going to go to the financial plan, which I have. So Jerry, I'll turn it over to you and let me know when you want me to go to the next slide. Jerry, I think you're muted, Jerry.
Yes, do you hear me well?
Yes, I can hear you now, yes.
Thank you. The goal of the financial plan is really to take all the concepts that Prashant spoke earlier and put them into one document where you could see, because talking about RSP, tax saving, taxation, how they work, sometimes it could be very abstract, but with the plan and with actual numbers, and also you're going to see the effect regarding the question. I think someone had a question regarding clawback. You will see the effect exactly of RSP and tax saving in a retirement. So Prashant, if you can please go to the first page. Okay, here, can you put it a little bit bigger, please? So very important for everybody. First and foremost, when come to finance, we have as financial planners and also as bankers something that is known as the KYC, which means know your client. And these documents really help us advise our clients. So in this page, who is my client? What do they do? Who are they? How taxation affect them? So in this case, we're going to, this is two clients over late 40s. Why we took clients at late 40s? In a financial plan, the closer, without being too close to retirement, the best advice you can provide. So here we have a business owner and an employee, both in their late 40s, going into retirement at 60 years old. 60 years old for the earliest retiree and 58 for Maria. Very important when it comes to making a plan, we have to know what is your investor profile. The investor profile, some of you, those who probably already have investment, the investor profile is the risk that I'm willing to take. Also, what with that risk, what type of return I can expect. It is extremely important because based on that, we'll be able to make projections. So in our case, we're talking about both a growth, we have a growth investor and a balanced investor, and you can see the return that they can expect from their plan. This is what we're going to use throughout their retirement to say, okay, those clients, based on the risk that they're willing to take, we're not going to give them more risk or less risk, but this is what they can expect. We don't want to be too conservative. We don't want to be too aggressive. There's a risk of being too aggressive, which is being overly aggressive, taking risks that you don't need, therefore having sometimes bad years. Or there's also a risk being over conservative, which means not meeting your objectives. So in this case, the clients were talking about rate of return of 5.83 and 5.28. If let's say, give you an example, let's say we put Maria as an aggressive investor. Yes, the return might be better, but in bad years, Maria might be 10 to sell the investment and not, and therefore basically selling at loss. And that's very, very important. I think this is when you start investing either tax saving or RSP, the KYC or the investor profile is probably the most important document. And often clients will go over and say, okay, my friend told me to invest in XYZ, not knowing that this is not a risk that I'm willing or capable of taking. Give you an example. I'm a self-employed individual. My cousin told me to invest in XYZ, which is maybe a penny stock. Am I, in my situation, capable of having a penny stock return could be a negative 100%. A penny stock is something that could disappear the next day. So even though, yes, it could be a great return, but in my situation, this is not a risk that I could take. So, so if we look at our clients, they have when we'll go, okay, what is the client? What is the risk they're willing to take? Age, also age going to guide us, and also what is their goal. So we see their main goal here is retirement, and at retirement they're looking for retirement of 42,500 each, 89,000 of retirement, 85,000 of retirement, which is very normal. We're talking about their current, based on their current income, which is a normal amount for retirement. So Prashant, if you can go to the next slide, please. So In the next slide, we're going to go over everything that Prashant had mentioned, but not in abstract, but in real time. So if we can see, we have Maria, who has a DCPP. People are going to say, what is a DCPP? This is probably the single most important aspect of retirement. And the reason why I wanted to cover it here, that most of you, your parents probably have pension plan at work. So typically the pension plan that were typically popular in the 60s, 70s, 80s, 90s, up until 2000 were defined benefit. What is a defined benefit? Which means you have your typical employees who work for Bell Canada. Bell Canada tells them if you work for 40 years, 2%, you're going to get 80% of your five best year. So I do my time. My 5 best year were 100,000. I'm guaranteed 80%. So I know I'm going to get 80,000 at retirement. That concept, since we can say the big crisis of 2000, when the tech bubble burst, that concept is less and less present in companies. What you typically have is what we call DCP, which means you take the risk, deferred contribution pension plan, which means you have an employee, the employee is saying, okay, I'm giving you, in this case, for every dollar you put, I could put either $1, I could even put more, I could put $2, but you're taking the risk, which means in this case, Maria put 13,000, the employee is putting 17,000, and Maria or the employer will manage the portfolio. This is very important because most individuals are often under the premises that we have the same plan as our parents, which is not the case. So often you, on top of managing your RRSP and tax-free saving, you will also have to manage your pension plan. We have the list of assets. So we have the personal investable asset, we have the lifestyle asset, which are in this case 2 houses. We have the corporate investable asset, which we'll be talking about the money invested in the corporation, for a total asset of minus the liabilities, which are the mortgages, for a total asset of 1.7 million. And you see the tax-free saving, the non-registered. So the reason why we started with the non-registered, before a lot of individuals, we talk about RRSP versus non-RRSP. We're also what we call the non-registered investment, which is basically an investment where, unlike the RRSP, whatever you earn is taxable. So most individuals will maximize their RRSP, maximize the tax-free saving, and with any extra money will have non-registered. As time goes by, they will try to deplete the non-registered and transfer it to the tax-free saving, hence saving the taxes on the growth of the investment. So this is probably on our case, this is the scenario. This is what we're going to see how to achieve it. If we go to the next slide, please. Okay. Prashant has mentioned capital gain on real estate. So we see here they have their principal residence, which is valued at 600,000. So which means purchasing price 350, 600, totally no tax. They have 600 net. On the second property, we're talking about a value of 300,000, purchase 120. We see purchase price, but we're going to assume there was no renovation, because if there was any renovation, it would increase, basically what we call the book value or cost of the property. So in that case, there was no renovation. So we're talking about a potential capital gain of 180,000. And also there's a mortgage. Sadly for them, the mortgage, the secondary residence is not a rental, it's just a cottage. And the mortgage is on the principal place of residence, so which means there's no tax deduction for that mortgage. So it's a typical mortgage that is going to pay with after-tax money, which is, we can say, 90% of the individuals in Canada. Next slide, please. Okay, very important. Once we sit down with any investor, we're talking sometimes the incorporated investor, those two concepts that you see here, the RTDOH and also the CDA balance. So the CDA balance, in a nutshell, we could say, this could be a presentation by itself. The CDA balance, often for those who plan to start business, already started business, this is basically the tax-free money that you're allowed in the company. So basically, this is money you already paid tax on that the owner could take tax-free. The RTDH, this is a virtual balance of basically tax on hand. So it's really a virtual concept that's saying tax on hand from the government. So those concepts are very important for business owners because they have some type of value. So even if the company was worthless, just the RDTOH balance could as a value because it's basically a tax. It's a tax virtual tax value to the government. So if you can go to tax slide 6, I want to go a little bit deeper into that. So in our case, it's very simple. We're going to cover. We have Maria, who has an employment income of 187,000. Chad, which is a business owner, only take dividend from the corporation. Why? Because he can. So basically, they did their budget. They say, okay, you know what? That's all we need to live off. So Chad will manage his budget. So we say, okay, we only need 192 to live off. So what Chad and often high income owners and and business owners will typically purchase either a life insurance for pension or what we call, and Prishant going to cover it, an IPP, individual pension plan. So Chad, basically, the company is contributing to a pension for him. The pension is $82,000 roughly. So the company said, okay, with the company money, he bought himself a pension plan. So that's Chad. And the pension plan basically, if Chad was ever to die, will pay half to Maria. There is a bridge. Often, what is the bridge? And some those who are employed will often see that. What is the bridge? I heard of that terminology. What is exactly a bridge? A bridge, name term, is before you can get your AOS, your pension is increased and will decrease as AOS. As you receive your AOS. In name term, this is what it is. So you see there's a bridge for 5 years between when Chad turned 60 until he turned 65 to cover. And as you get, when you're going to get AOS, it's not typically the same exact value, but it's a little, that's why we call it a bridge. So a higher income for that period. And as you reach 65, that's going to wipe up and will cover by the AOS. You see the different government pension. We had mentioned about RRSP and different things. We have different government pension. In Quebec, we have QPP, sorry, Quebec Pension Plan. In other provinces, they have the CPP, Canadian Pension Plan. Everybody has the AOS. What is the difference between those two? AOS, every individual who spent 40 years in Canada will receive it. You could have worked 0 to 100% of the time, you will get your AOS. QPP and CPP are contributory pension. So you all contribute to those pensions, either on the Canadian level for the provinces or in the Quebec. In Quebec, it's about the first 50,000 that you earn, you contribute to them, and then you stop contributing. It's a maximum of 50,000 that you contribute. This is the level of contribution. You could see it often. People will realize that depending on your income, June, July, I see my income after taxes a bit higher because I stopped contributing to the QPP. AOS, it's non-contributory. Every Canadian has it. The two others, it's really contributory pension. If you go to slide 7, please. Okay, so it's very simple. Often most individual, and this is why it's very important, the most important part of every plan is to have a budget. The budget is the most important tools that you can ever have. Before RSP, before everything, is your budget. What comes in, what goes out. In their case, they know that pre-retirement, we need 100,000 to live off. Post-retirement, we're going to need 85,000. Very important. And this, if one survivor, and often people will be under the belief, oh, if I'm by myself, I'm going to need half. No, because some expenses will be full. You're still going to pay for IJO to almost the same amount if you're by yourself or with a spouse. So most expenses, so in their case, we're talking about 68,000 if Chad was to die. Why we put Chad? Chad is a bit older, so that's why. We see that I talked before about the DCP. So in our case, Maria contribute 18,000, and the company said, I'm going to give you 11,000. Why they're separate is very important. The reason is it's similar to an RSP, but with big difference. The DCP later at retirement will be what we call a life income fund. What is the difference between a life income fund and an RSP? the life income fund has a minimum and a maximum, and there's a calculation. RSP, you have an RSP of $1 million, you want to cash it tomorrow, you go, you pay the taxes, you cash $1 million. You have a DCP, you're at retirement, it was worth $1 million, you want to cash it? No, minimum, maximum. So those are very important concepts when you are, the reason is very simple, that money is a pension, so the government want to make sure that it lasts you throughout your retirement. So that's why, because the pension, the government said that I put limitation to your minimum and maximum. RSP, it's not, you take it as you see fit. Except at RSP, you have to start taking it at 71, but you're not under the obligation to take, you could take as much as you want. You have no maximum in your RSP, as in the life income fund you do. And we see a spousal contribution. Again, the spousal contribution, it's a way to do what we call income splitting with the spouse. We see it less and less, but often when there's going to be at retirement, there's going to be unbalance. So the spouse with the highest income will at retirement will tend to give an income to the other spouse through a spousal contribution. So a spousal contribution, the spouse contributor will get the tax receipt, the other spouse receive the amount. So in our case, Chad contribute because he has a very good IPP. So he contributes 5,000. So Chad received the receipt, and Maria gets the money. Okay, if we can jump to 8th slide, please. Thank you. So I was talking about the budget. So you see the budget, and this is the typical budget for when you have a business owner. So which means I will balance to the T my income. So you see 187, the income of Maria, Chad 5,000. Guess what? That's the total amount that they need. We see how much they will receive, total expenses. Normally, the business owner will typically manage his income to make sure that he doesn't pay any extra taxes. That's the advantage. That's one of the big advantages of being a business owner, is that is really being able to generate the income that you would need. So in their case, we see there's a very tiny surplus. We're talking about 1,600 over 190,000. This is like less than 1%. This is a very good management. And you see the debt repayment is in there. So I'm pretty sure as the debt wind down, there's going to generate surplus that we could reallocate at different places. So if we can please jump to slide 13 to go into details into, okay. So you can see in slide 13, this is very important. So you see, as I mentioned, they had non-registered. What they're doing is transferring the non-registered to the tax-free saving. So the income generated could be tax-free. You have the RSP asset. So the RSP asset at retirement will be transferred into what we call RIF asset. The locked-in asset, what we call the locked-in pension, this is basically the pension money, the DCPP, will be transferred into locked-in asset, a LIF, what we call a LIF, life income fund. And we have the money in the corporation, which at this case was 200,000. That money is growing. Why? Because Chad is not taking any of it, and also with the market. So you see the net worth is really increasing as time goes back. So we're talking about a net worth of 1.7 at retirement, compared 1.7 right now, and a net worth at retirement of present value. You see in the left column there's the net worth, and there's also the present value, which means with inflation we're talking about a net worth of 2.7 million. I know a lot of you probably going to say, oh, but the real estate is really not going fast. Even though, and this is a debate that we often have even in our team, even though in the past, we can say, for people in Quebec, we really say in the past 5 to 10 years, real estate have been growing at double digit. For projection, we put real estate at 2%, which is near inflation, or maybe a bit above inflation. The reason is very simple. For those who were in Quebec in the 90s and beginning of 2000, real estate grew up about 0%. So often you will see a push in real estate where for 5, 10 years go at a double digit, and then for a long period, real estate stays stable. So because of that, when we're doing a plan, we tend to put real estate at inflation. So we don't see you don't want to see you losing money, but we rarely will put your real estate at 10%. Why? Because most likely when you look at taxes, maintenance, into real estate, it comes to inflation. Often people will say, yeah, but my house took 20,000 over the past year. But when we look at the renovation that you put, the taxes that you pay, often will be close to inflation. We're not talking 2020 year, we're talking about really a long term. Over long term, real estate will go at inflation. Of course, so the people will say about the Vancouver market and those markets. For those markets, will typically be a little bit more aggressive, but for most markets like Quebec, we really will stay at the inflation level in the long term. So if we can go to slide 20. So in slide 20, what we're going to look is at really the taxation at retirement. The taxation at retirement is quite different than, if you could go a little higher, the taxation at retirement is a little bit different than during normal time. You see here, he's receiving his AOS. We have then the pension. That's the pension from Chad. And then you see we have the lift payment. So in our case, Maria is taking really the bare minimum, 41,000 of her pension. Then you have the total income, 142,000. The cash outflow, this is basically their needs after taxes. So we see the taxes, and so at retirement, they will have a surplus. This is really odd. You're gonna see their surplus right now is higher than their surplus during the working days. Again, it has to do with the lift. So in their case, she has to take that amount. This is the minimum that she has to take. So she's gonna get a higher surplus. What she's gonna do with that surplus, often people at retirement will do, they will use it to fund their tax-free saving. So the advantage of the tax-free saving, again, is that it's something that you can take year-long. So in their situation, I don't know if you recall what Prishant had mentioned, some people will not necessarily maximize their tax-free saving during the working days. They might do it after. So in their case, this is the scenario. So the tax-free saving in our scenario become an estate tool. So they're going to maximize the tax-free savings to leave tax-free money to their kids. So that's a very savvy way of increasing your estate, the money that is being passed on to children, the use of tax-free savings. So they have a surplus. They're like, no problem. I know I have the surplus. I'm going to put it. That tax-free saving going to grow at their investor profile rate. We're talking about close to 6%. So we know we're gonna leave tax-free, because don't forget the tax-free saving is also to your estate. It's tax-free. So I'm going to use a big chunk of money between and as Prishant mentioned, there's really often in Canada, we're under the impression as the working class, there's no tax advantage. But if we look at this scenario, they're going to maximize the tax-free saving. It's going to be passed tax-free. They're going to maximize the residence. You have one resident that's increasing in value. Again, it's going to be tax-free. They have a good dividend cash on hand in the company that's growing. They're going to pass again with limited taxes if they use their the small business tax exemption. So really, tax-wise, there is ways for people to increase the tax deduction even in Canada. So if we go, Prashant, if you can please go to the slide 28, we're going to cover exactly what I just mentioned, the estate strategies. Thank you. So if you look, another way of passing tax-free to your estate or limiting the tax is the use of insurance. So you see, in this case, at age, let's say you take age 63, which is 2035, you see they have a total net worth of 3.2 million. They have a life insurance. They have a tax liability of 1,967,000. The use of life insurance. So after insurance, actually, it even increased their total estate value. The use of insurance. So often, individual who know that they have, because they have a lot of registered asset or somewhat businesses, will often use the life insurance as a strategy to protect against taxes at death. So we see, and as we're going to see, if we go a little lower, you're going to see eventually they don't. The next page, they don't carry the life insurance anymore. Why? Because often the life insurance become either too expensive. So like this has become way too expensive, so it defeats the purpose. But what did they do? Look at their net worth. They save so much through the use of the money that went to the tax-free saving, and the increase of their net worth. They're like, I don't need really that. That life insurance becomes too expensive because my net worth, if we look, it's at 1.7 million. So I'm at retirement. I have still a net worth of 1.7 million, which is basically my net worth before retirement. So I'm not using most of my money. You see, in their case, they're not using most of their money. So they're like, you know what? The life insurance was a great protection before because protecting against taxes, but now I built my net worth and the life insurance become too expensive. So I'm going to get rid of it because my net worth is really at that point. So if we do a recap, that family is a typical, we could say typical Canadian family. They have all the advantages, which is a business owner that can manage his income to limit his tax liability, a spouse that is working with a pension where she contribute, manage the risk, investor profile is balanced, and they manage their expenses. So therefore, they have a very, very large period where they can save. And at retirement, the amount that, which is still a good amount, we're talking 85,000 after tax, that amount, because their investor profile and because of all the good tax structured, which means if there's any extra need, because we say we put 85,000, but another use of the tax-free saving, if let's say for one, let's say they say my need is 85,000, but year 5 of retirement, I want to go and visit Europe for 3 months. It's going to cost us $50,000, $60,000. We're going to take it from the tax-free saving, tax-free, so we're not increasing our income, therefore increasing our tax liability, because we know in the future year we'll be able to put it back. So one question was, if I have 110,000 in tax-free saving, I withdraw 110. Do I have to put back 72, 110? I could put back 110. This is another great advantage of the tax-free saving. I can put back whatever I put, even if it's higher than what's allowed by the government. So it's another great advantage. So in our case, they're using the tax-free saving really as a tool for saving, as a tool for estate management, and as a tool also to manage cash flow. And you see that in really the tax liability, which really, if you look at the tax liabilities, really stay very low for the level of income that they have. I'm going to check on the questions. See, there's several questions. So give me 1 second. I'm going to try to open that. Okay, give me 1 sec. Okay, we went over this. Okay, one question was, is it a good idea to use your RSP to buy a house? There is what we call the home buyer plan, which allow you to take 25,000 from your RSP and put it back. For sure, it is always, depending on every scenario, typically at large, it's a good idea. If this is where my down payment going to come from, most individuals, when they start working, they maximize their RSP and their tax-free saving. So after taking money from my tax-free saving, if I need some more for my down payment with the increase in prices, most individuals will be forced to take from the RSP. So it is a good idea. And you will be able to put it back without being taxed, because when you do the home buyer plan, you're not being taxed on the withdrawal. So I take 25 tax-free and I have 16 years to put it back. So it's really a good scenario if I know I'm going to put it back. If I have the money elsewhere, no, leave the RSP going tax-free for that amount of time. But if I don't have the money elsewhere, yes, it is a good idea. Okay, well, another question is, because of COVID, we had to rent our winter home in Florida. The home is in me and my wife's name, but the money we bought the house with came from my investment account. Question, can I split the rental income with my wife for tax purposes? This is a very good question. If you do, this is the if you do, you have to keep doing it. Often where people make a mistake is they will split it 1 year, don't split it another year, and not sell. One person will claim the capital gain. No, you have to be consistent. The fact, because like you said, my wife, the fact that you're married and CCR are not going to come exactly from which account the money came. They're not going to go in that. They're going to go with consistency. If you split it in 2020, make sure to split it in 2021 and on, because then you're going to really get audited. Because if you see an rental income of, I don't know, 15,000 1 year and the next year 0, it's a red flag. And also often what people will do is and this is a big no-no, often what an individual will do is they have a property, and for the first 5-6 years, it brings negative rental income. So the higher end earner spouse, let's say in our case it was Maria will take all the deduction. And then for some reason they sell it, there's a capital gain, and Chad will take the capital gain. It's a big no-no. You took all the income, you're going to take all the capital gain. You split, you're going to split. So that's very a strategy. How can property be passed on to adult children? I'm trying to understand. There's no capital gain. Are we talking about the principal place of residence? The principal place of residence, you could sell it. You're just in Quebec going to have to pay the welcoming tax, that taxe de bienvenue, on the market value. If it's a rental, it's the same. You're going to sell it at market value. There's no way to transfer it tax-free, if that was the question. Does gender affect your tax planning strategy? Actually, gender doesn't affect it at all. What will affect is how old did your parent die? Give you off. That's the first question we ask. If someone say, okay, both of my parents died at 110 years old, that will change my planning because I will put you to die 110 years old. But gender doesn't. It will be health and really your health and your parents' status. That really what will affect the planning strategy. How many times should I revisit your tax strategy if it's different for a single person versus yes? Tax strategies should be revisited at least once a year. The reason is because tax are not set on stone. Like Prishant mentioned, if we look at the different government platform, they have different rules. So let's say it's not true, but let's say there's one of the party who said, if I get elected, I'm going to tax principal resident at 100%, and I'm going to double the tax I'm going to abolish the capital gain exemption and everything. So yes, you have to visit every tax strategy because now it's everything has changed. So it's very, very, very important to revisit it at least once a year. Don't see any other question. I will pass it to Prashant to go over the different strategy that we do for our clients. Thank you.
Okay, great. Thank you, Jerry. That was excellent. So, we're I just want a little tight on time, but we're going to cover these last section pretty quick, and then we'll answer any final questions and wrap up, at 7:30. So basically, what we wanted to do was show you what some of our clients who are more high net worth are looking at from a tax standpoint. What are some of the more sophisticated strategies that hopefully everyone on this call will be able to visit at some point in their life. This is not an exhaustive list, and typically the high net worth strategies are for those individuals with, I would say, at least $1 million of investments. And we're going to cover these. I'm going to cover the first 4. I'm not going to cover the last one, which is flow through tax shelters, but very quickly, that's basically the government gives certain tax incentives if you invest in mining, oil, and gas types of investments. But of course, there can be some volatility with those investments. So let's go through these very quickly. So I'm just going to put all these bullets in. So basically, if you have a family and you have a low-income spouse or low-income children, typically minor, as I mentioned before, every person in Canada can earn a certain amount of income tax-free. So if you had investment income primarily, so you maximize your RRSP, maximize your TFSA, and you have a lot of surplus cash that you're generating investment income on, you can actually split some of that investment income with a low-income spouse or low-income children, and they can earn tax-free income. So the way to do it is you have to take cash that you have in your personal name and loan it at the current CRA prescribed interest rate, which is only 1%, to either your spouse or to your children. And if they're minor children, then you have to set up a family trust. Any investment income earned over the 1% that you're charging on that loan can be taxed in the name of that low-income family member. And in particular, if you're earning Canadian public company dividend income, as you can see, each of your family members can earn 50,000 of Canadian public company dividends tax-free each and every year. And if you're earning that in the name of your minor children, what we're seeing a lot is if they're in private school where the fees are very expensive and you're paying those fees with after-tax dollars, this is a way to actually pay those fees with tax-free dollars. So this is a very popular strategy. Most individuals in Canada cannot take advantage of this because they don't have the surplus cash. It's mainly for the high-income family members. So you're probably familiar with maybe 3 out of the 4 individuals on this slide: Mark Zuckerberg, Warren Buffett, and Bill Gates. The lady on this slide is Sarah Blakely. She is the founder of Spanx. Some of you may be familiar with that. But what do these people have in common, other than they're stinking rich, is that they are committed to philanthropy, and they have committed to what we call the Giving Pledge, where they're going to give away the majority of their wealth. And this is through a lot of people. That's interesting. It's changed by itself, but basically a lot of people and are giving money to foundations, the high net worth individuals. And I'm not going to get into detail, but for those high net worth families, you may have heard that they set up these family foundations, and they basically give money from that foundation on an annual basis. But the initial seed capital of that foundation, they get a very big tax receipt. So we see that very commonly done with people that sell their business, have a very big tax event. They set up a charitable foundation. The other thing people do, Jerry talked about life insurance, and you know, a lot of you in this call probably have some life insurance. You maybe got the life insurance when you were young, or when you had a young family, and you want to make sure, if you pass away, God forbid, that your family, your spouse, and your young children are taken care of. That's your typical form of risk management or term life insurance. And there's a pure cost to that, because likely, you know, you're not going to die until a very ripe old age. And, you know, that's the pure cost. Our higher income family members, they're investing what they call permanent life insurance, which is, as the name suggests, it's there for life, it's permanent, and it never expires. In Canada, people are putting a lot of money into those life insurance policies because life insurance in Canada grows tax-free and pays out tax-free. So if you have a lot of surplus wealth, people are using life insurance as an investment, but that's really only eligible for people that have a lot of surplus cash. If you have a business, which a lot of our high net worth family members, a lot of our high net worth Canadians are business owners, if you can earn active business income in a corporation, the first 500,000 of that income is taxed at a very low rate, only 13%, compared to if you earned it in your personal name, you're going to be paying close to 50%. And over 500,000 is taxed at 26%. So we see a lot of business owners that are growing their wealth through their business using a corporation. Jerry mentioned IPP. That's the kind of the business owner's version of an RRSP. It allows a business owner over the age of 40 to contribute more to a pension plan than the RRSP allows. And last but not least is something called an estate freeze, and that's a way to basically transfer the business on a very tax efficient basis to the next generation, and also set up the business for a sale where you can basically multiply what we call the capital gains exemption with your family members. So these are more sophisticated business owner tax strategies. So that's it from my standpoint. What I'd like to do is turn it back to Jerry, who's going to talk a little bit about, just to wrap up, give you a bit of a checklist of things that you may want to consider for your own, personal situation. And Jerry, I'll pass it back to you.
Thank you, Prashant. This exhaustive list, I think, will cover everybody. There's nobody could be. It's for our high net worth client, the same way from someone that's just starting in the workplace. Contribute to an RSP, tax receiving, or both is really possible, but you have to at least do one. The prioritized payment, it's an investment strategy. It's really to dollar average cost. So you're buying sometime higher, but most of the time, dollar average saving really is compounded over time. So this, and also from a budget point of view, you include your saving into your budget. So it's a very, very efficient tax strategy. The RRSP, we didn't mention the RRSP, we didn't go over it. But the RRSP, because of the tax, the contribution of both provincial and federal government, we're talking about close to 30% for 30 cents for every dollar you make between federal and provincial. So this is a must for every individual with kids. The life insurance we had mentioned, the will. Often people will say, "Oh, will and POA are extremely important," and I think for a group of age, probably the POA or the mandate is very important. The mandate, sorry, is very important because in case of incapacity, you don't want the public creator to be the one deciding of what needs to be done financially and also medically. So that's extremely important. Minimize tax deduction debt. So this is a strategy. I'm going to take a minute there to explain. This is a strategy that often people will use. I'm going to give you in a nutshell. Let's say I have a residential home with a mortgage of $200,000 and also have investment, non-registered investment that is for the same amount. So in one hand, I'm paying the interest on my mortgage after tax, and I'm being taxed on the investment income. So what we'll do, we'll look, okay, what is the tax impact of me selling that investment? Let's say the investment is extremely conservative. There's I don't know, maybe 2,000 capital gain. So I'm like, okay, I'm going to sell the investment, pay the mortgage. So that means I have zero mortgage, zero debt, zero asset. And then I'm going to remortgage for the 200,000, but that 200,000, I'm going to buy investment in it. So basically I'm leveraging. So that 200,000, because it was used directly to buy investment, so I mean the interest is tax deductible toward the income. So let's say I make 10,000 of income and I pay 11,000 of interest. So I just save 10. Basically I'm only taxed on. I just basically waive my taxes. So it's a very good strategy for people who have to create it to turn in non-deductible debt into deductible debt. So very efficient strategy. Doesn't cost anything. Doesn't need anything. You just have to remember. And the last one is family income splitting, as Prishant had mentioned. Very important when you have either adult kids or spousal with different link of income. So also the next slide, what we want to cover recently, CCRA had sent a simplified T1 general. I don't know if any of you have seen it. It's much simplified. Prashant, if you want to show it to our guests, it's really efficient. This is the most efficient one. How much money did you make? Send it to us. This is the best, the new simplified T1 general. And also for people who are asking, what do rich people do in order to save on tax? The next slide really explains to us what they do is very simple, and that's what Dear Revenue Canada, I'm writing you to cancel my subscription. Please remove my name from your mailing list. This is again one of the best tax strategy that we wish we could use, but sadly those two are really jokes. They are not being used. Don't do them and saying that Jerry told me at a tax planning seminar. Again, that's why we have the disclaimer. Do not use those past two tax strategies. They're not in place yet. Maybe if one of the parties elected, they will put them in the platform, but we can always hope. So on behalf of Prashant, myself, and obviously Wealth Management, I would like to thank you for your time. And if we have any question, we're open either for any question for either Prashant or myself. We're open for all your question.
Looking at the chat, I think we've answered all the questions so far. I guess if anyone has any, further questions, you can maybe pass them on to the McGill folks, and they can loop us in as appropriate. At this point, I don't see any further questions, so I think we could maybe there is some question here. I see here. There's one question. Are there any tax strategies that can provide the most tax savings bang for incoming bucks, especially for those of high net worth? How can someone who's a high earner reduce, minimize taxable income? So I think that question it was related to the strategies that I mentioned very quickly at the end. So if you're a high income earner, things like charitable giving, things like family income splitting, or things you could look at, using life insurance potentially as a long-term permanent investment. I didn't get into the flow-through shares, which again are big tax deductions that are taken if you invest in certain resource-based investments, but there can be some investment risk with those. So you want to be careful. As we say, you don't want the tax tail wagging the investment dog. So those are the main ones. Again, if you're a business owner, you're able to probably have a few more strategies available than an employee. So it's really fact dependent and based on your family situation and whether you're a business owner or employee. We would kind of look at all those factors to determine what are the strategies. And I think that is it. So I think we're probably near the end of our time. I can turn it back to Sandrine and to maybe end the call. Oh, one last one. Maybe Jerry, did you want to take this? It says that if one has a choice, which would usually be better going forward, the defined benefit pension or the defined contribution? What should a person consider?
You know what? It's a question that has to do with, and I'm going to give you an example. So this is a true story. Recently, I met a client. The guy used to work for a normal company, and he had a pension. He was 42 years old, defined contribution, and the pension was minimal, 164,000 of pension. Believe it or not, he turned it into 3 million in 24 months. So if you're asking me, and yes, this is a true story too. So if you ask me, it's really risk tolerance. So if you know you are very conservative, there's a calculation. If you know you're a very conservative investor, so you do your investor profile, your rate of return is 2% because you're really, really risk adverse. You look at your pension and you see the pension is paying you a guaranteed amount. So you're really risk adverse. So often that individual will go into the defined benefit because they're extremely risk adverse. Some individual will say, I'd rather manage my own money. I'm willing to take the risk, manage my own money because I'm a better investor. And also family situation. If I have no heirs, I'm single, no kids, often defined contribution will be better because it's transferred into a life income fund as defined benefit, which is a pension, and often no heirs, the money goes back to the pension. So it's really a situation where we'll sit down and case by case we'll analyze and we'll say, okay, based on your situation, it's better. So it's not a cookie cutter, but for sure, risk adverse people, I would say defined benefit, and that will be, but your family situation play a big role into it.
Yeah, we're finding, if this individual asks a question, has the option for a defined benefit plan, I think they're quite lucky because most employers are not offering a defined benefit plan. RBC, any new employees wouldn't have the defined benefit plan, which is, I think, pretty well most banks and financial institutions. So, that's something that you need to be aware about. You may not have that option even for most people. Yep. So. Looks like another final question. Looks like we still have some time. When should I start to plan my year-end tax strategy? I would say not December 15th. From my perspective, I think you're planning throughout the year, to be honest with you. I think people start looking at it maybe more in the fall, but there are things you can do throughout the year to help minimize your taxes. So, we see things like tax loss selling and charitable giving happen more near the end of the year as opposed to the beginning of the year. But, it should be top of mind, not when you file your tax return where you have a big tax owing, because then it's too late. But yeah, I'd say certain tax strategies are more done kind of in the fall, but you want to definitely keep it in mind throughout the year.
Normally what we advise our clients is, and that's why the prioritized payment, we do everything prioritized. So basically your tax strategy year end in 2020 is not going to be so much different than 2021. There might be some fine tuning. So you should, like you mentioned, you put it in place once and you fine tune every year, but it shouldn't be really a big change. It should be just fine tuning as we'll say in the fall, but it should be already been put in place once, and then every year you're just going to revise it based on the new tax strategies.
Yeah. Are there any key elements of effective tax planning? Well, you know, I think a fairly general question, but I think a lot of the stuff we talked about today, you know, I would say in terms of RSPs, TFSAs, you know, for higher income earners, family income splitting, charitable giving, life insurance, things like that. So, you know, you want to maximize all deductions that are available and credits. So for many people, does mean working with a good accountant, because it's getting more complex, our tax system. And also the government is closing a lot of the tax strategies that were available for many of us. So particularly the higher income earners. Again, there's no cookie cutter, but there's some basic things which we talked about today. And a lot of it starts with, you know, things like the TFSA, RSPs, RESPs, and things like that. Okay, I think we're probably at the end now. I know it's been a lot of information we've been throwing at you, so you know, hopefully there's some tidbits that you've taken away, but I'll turn it over to Sandrine to maybe cap our call.
Thank you so much. Thank you, Prishant and Jerry. I think I speak on behalf of all the audience. We learned a lot. It was very informative and insightful. So we thank you both so much for your time and for your expertise. And thank you for joining us today. As well, thank you to the audience for your questions and your participation. It's been a great session. And we thank you for joining us. We invite you to stay connected with the MBAA via LinkedIn, Facebook, Twitter, all that good stuff. And stay tuned for more events.